Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be sharing with you why you could be risking much more than you think when investing in ETFs. I'll also give you my views on the Dow Jones, and then we'll get into some stocks of interest for this week. Also, thanks for joining us. I'm sure you'll gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. Remember to subscribe to our channel now so you keep up to date, and remember to click that like button. Also remember to get onto the Wealth Within live stream. The stock market show is on every Tuesday at 7 to 8 p.m. Australian Eastern Time. So let's get into this week's report. Now it seems like every week someone is asking me about exchange traded funds, or ETFs as they're known, with the majority talking about them as if they are the next best thing to sliced bread. Now let me say right up front, for the most part, ETFs are not nearly as good for your portfolio as you might think, and for many they are taking higher risk with their money than they actually realised. Now in this report I will share with you why that is, so let me explain. Over the past decade since the GFC, investors have increasingly sought a way to get better returns and greater diversification in their portfolio. Now the issue is that they're also seeking to do this with very little effort, hence the stellar growth in exchange-traded funds. Now on the surface, while exchange-traded funds can seem to offer the investor a good vehicle to make gains by doing almost nothing, they also have their downside, which the masses of individual investors do not ever consider. The ETF and funds management industry has done an amazing job of promoting this investment vehicle. After all, managed funds were decidedly on the nose after the global financial crisis, and the masses were voting with their feet, saying they wanted more control over their investments, and so they moved to direct investments, and as a result bypassing the funds industry. But that is where human nature takes over, as history suggests that most investors are passive, meaning that they want good, safe returns, but they want someone else to do all the work for them. History also tells us that the majority do not do enough research, such as reading prospectuses, offer documents, and other important information prior to investing. Now, the industry has fought back to stem the outflow of money, and as such has put a lot of effort into convincing us that exchange-traded funds are the best way to go. Hence the newfound popularity of exchange-traded funds. After all, you can gain exposure to a market with one transaction and gain perceived control over your investments, as you can sell the exchange-traded fund on the exchange anytime you wish. Oh, happy days! But again, history continually tells us that investors buy at the wrong time, and then they either do not sell or hang on way too long before selling. Just prior to the GFC peak, we saw all-time record investments were made into funds, meaning everyone was getting in at the last minute. We also saw the opposite occur just prior to the low in 2009, when the market had fallen around 50%, and that was record levels of investors leaving the funds. En masse investors repeated that old mantra that says the amateurs buy at the top and sell at the bottom. So why would the story be different now with exchange-traded funds? Well, the short answer is that nothing will change, as history also tells us that en masse we do not learn when it comes to the markets and investing. As I mentioned, ETFs have been marketed very well and as a result are considered low risk. After all, professionals are managing your money. They also promote that they offer a much wider diversification of your money into stocks and other markets, and can do so more efficiently than you could yourself. Sounds like a perfect world, doesn't it? Well, it's not as rosy as that. You see, set and forget is never a good strategy, and investors will get burnt again sometime in the future when the market falls, which we all know it will eventually do. An interesting statistic is that 53% of advisors are currently using exchange-traded funds for their clients' investments. Now, to me, this is no different to what was occurring prior to the global financial crisis. They've just switched from investing clients' money into funds directly to funds that are listed on the stock market. Now, this may give clients the perception of control over their money, but nothing that is too different than before. Don't get me wrong, exchange-traded funds can be a good investment vehicle, especially when you look at areas that are highly technical and hard to understand, such as cybersecurity. Now, BetaShares has an ETF called HACK. Yeah, you heard it right, the ETF is called HACK. This ETF aims to track the performance of the Nasdaq Technology Association Cybersecurity Index before fees and charges. Now, I'm not suggesting that this is a good or a bad investment, and BetaShares really is a good trusted company. The point is that if you wish to have a small exposure into a growth industry that is hard for most to understand, then this is where ETFs can be great. As I suggested, set and forget investing is not wise. And just because you have some ETFs does not mean you can sit on the beach drinking pina coladas dreaming of riches from doing very little. You also have to consider the fact that Warren Buffett has come out and said he's not a big fan of ETFs, and as you can guess, I'm not a big fan either. I would go as far as to say that if you're using ETFs for index investing, then you are not managing your portfolio as effectively as you could. And you really do need to read my book, Accelerate Your Wealth, as it will change your life and you're investing for the better. So what are the risks of investing in exchange-traded funds? Well, first and foremost in any investment are two things: systemic risk and specific risk. Systemic risk is the risk of the market, and specific risk is the risk of the investment itself. Now, in my book, I have a bigger, more detailed answer on these areas, but I think you get what I'm saying. Like I mentioned before, when chatting about the HACK ETF, they generally track an index. Therefore, the ETF itself is invested in a range of investments, which in this case is technology stocks, so as to track the index. Now, like any stocks, they can and do fall, as did all the FANG stocks like Apple and Amazon, which all fell over 30% last year. Market risk is the biggest reasons why buy and hold should be avoided. Now, specific risk is the ETF itself, and in the case of ETFs, it's also called counterparty risk, whereas your risk is not just the investment, but the party supplying or managing that investment. Now, if they go broke or get into trouble, then your investment can be affected. Other risks include liquidity risks, meaning you may or may not be able to buy or sell your ETF, or buy and sell at what you might deem a fair price. You also have hidden costs that might affect the performance of these investments. Now, these can be trading costs within the ETF, amongst other fees such as commissions, bid-ask spreads, and other charges that you might not be aware of. Another risk is what the ETF is actually tracking, and can it perform equal to or better than what it's tracking. Here, depending on the fees and other variables, you may or may not be getting what you think. Other risks include tax implications and, dare I say, closure of the exchange-traded fund itself. Probably the biggest risk I see is investor behaviour. Constantly I see investors trying to outperform the market and take high risks by attempting to hit it big by following the perceived next big thing. This herd mentality into, say, things like rare earths, lithium, or as mentioned before, cybersecurity or artificial intelligence, and the list goes on, is and can be fraught with danger. The old rule, if you don't understand it, don't invest in it, rings true here. Just because something sounds great does not mean you need to invest in it. We've seen investors' portfolios decimated time and time again through market meltdowns. But more, we've seen investors cause their own demise through bad and poor investing decisions. So the golden rules to take away here are: educate yourself, always read the details so you understand what you're investing in, never take high risk speculating, and above all, protect your capital by having an exit strategy. So now let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Isn't the market an interesting place with all the bearish news around? You would think the Dow Jones would be starting to fall away, but last week it took off like a rocket, gapping up and being very strong for the whole week. So let's go and have a quick look at the chart. So on your screen right now, you can see on the left-hand side, you've got a monthly chart, and on the right-hand side, we have a weekly chart. The interesting thing that I'm looking at on this monthly chart, if I just bring that up a little bit and bring it down, you can see it's quite interesting in terms of, let me just go and put that on there. You can see all that's pricing here, all your opens and closes all around this sort of area here, and this sort of ranging price, and that's from all of this year. So we can see here from early February, or from February, there's January at the start there. So this year it's been really moving in an interesting sort of range. If I put my pointer on from there to there, you can see here, if I just expand that out, that's 15% range roughly it's been moving in for the first 3 months of this year. Now obviously we're just into the first week of April, or into that second quarter of the calendar year. And it's been, as I said, it's been roughly moving around 15%, but we've made higher highs and lower lows in that particular time. Let me just get rid of that so you can see that. Let me get rid of that. So you can see a higher here, higher high, lows through here, and a lower low there. Be interesting, there's a lot of indecision around, and I'm not sure why, but there has been a lot of bearish news about, hey, crashes. And as I said to last week's video, there's a lot of clickbait videos, people talking about the stock market crashes and all sorts of other things, and just to get you to click on them. But it's not necessarily giving you solid information. It's really about what is your plan. The market is, you don't buy the market, you buy the stocks. And this is really where I talk to a lot of people about it. They worry about the market going up and down. I don't care whether the market goes up or down. All I care about is the stocks that I own, whether they go up or down, and that's what I'm managing. So I don't need to worry too much about the market. It is nice to know where the market is heading in terms of, is it more bullish or more bearish. If it's more bullish, you're going to see more stocks rising. If it's more bearish, you're going to see more stocks falling. But I could sit here for ages looking at all the S&P 500 stocks and look at some of the most bearish periods, even through the GFC, and I'll show you stocks that have gone up quite well during that period of time that you could have traded whilst the whole market was falling. And I could show you stocks during the bull run through to 2007, that massive bull run, and even the massive run that we've had since 2009. I could show you stocks that are falling away in that particular time whilst the market's rising. So always get down to what's happening in your portfolio. So where do I think the market is going? Right now, it's looking really, really nice, and I still think it's got more to go. I don't necessarily think the market is super bearish. It just needs to break out of this. It's just really slowing down a little bit. As I said, I did expect it to fall away a little bit because it really hasn't fallen away too much. And where's my little tool here? If I whack that on there, it didn't fall away very much. You can see it just above that 25%. I would have loved to have seen it come down to this sort of 24.5 or even down to $24,000 points to really slow down the momentum a little bit to get a much more sustainable rise moving forward. But right now, really it's the tale of, is it going up or is it going down? Yes, it's going to do one of those, and you say, well, Dale, that's pretty obvious, but how is it going to unfold? Right now, if it does continue to go up at this sort of rate, then we might see that run will end pretty quickly over the next 1 to 2 months and have a bigger pullback towards the end of the year. If it goes down now, which is not looking like it will do, but if it does fall away now and come back down to that sort of 24,000 points, then it might do a more shorter term pullback for more bullish into the second half here. That helps you understand whether you should be getting into the stocks or getting out of the stocks or looking to get out of it, how that market's going to unfold, because what will happen is it will slowly get reflected in your portfolio depending on how many stocks that you've got. But what I want to do now is let's look at some stocks for the week. So I'll just bring up my workbook on that. I can just see that. What I want to do is talk about some stocks that I found this week. I've been chatting with somebody from in California, just not far from Sacramento, a lady there. She's looking at managing or taking over her portfolio. She's got a bit of a portfolio. She has been using an advisor for many, many years to help her with her investing, etc. And she's now looking to be much more direct or directing herself in her investments a hell of a lot more and understanding, and that's why how she's found myself. And we've just been having some chats backwards and forwards, and she said, here's my portfolio Not for advice. I don't give advice in terms of financial advice. That you do need to have a proper advisor to really go through your financial situations properly and really come up with a plan. But financial advisors around the world are the same. Really much what they try and do is make things as simple as they can for themselves so that they can make some good profits. Obviously, income, that's what they get paid to do, but not necessarily. What they're trying to do is they always squash volatility. And what I mean by that is if you've got a range between a low and a high, that's the range, that's the volatility. What they try and do is bring that all together so you don't get too many downward dips, you don't get too many high peaks. So they're taking out the big moves, and that's why the market or the industry constantly tells you can't time the market, because what they're trying to do is squash volatility so you don't get the big meltdowns of 40-50% on stocks or your portfolio. So what they do is they over-diversify your portfolio. This is all stuff I talk about in my book, Accelerate Your Wealth. It's on Amazon. You can get it. You can download an ebook from Amazon or your local bookstore around the US. But what they're talking about is they buy more stocks, so you're averaging a different return. So this lady had 16 stocks in her portfolio, which actually surprised me. Normally when I see portfolios made by advisors, there's sort of 20 stocks or more to squash that volatility, and they generally sector invest, so they have a certain amount in every sector so to balance out the return, because the theory is one sector's rising, another one's falling, another one's going sideways, but they squash the volatility by doing that, so they get an average return. Whereas I often say, get out of the ones going down, get out of the ones going sideways, and just have ones that are going up, and you'll get better returns. People want better returns at low risk, and you can do that through directly investing. I'm going to have a look at a couple of the stocks from this lady's portfolio, but it's been a really interesting chat with this lady. She knows who she is, and it's been a really interesting chat, and I'm looking forward to chatting a lot more with her. But anybody can take control. Now, this lady has had a long history of running her businesses and with her husband and everything else, and her husband's passed away. My guess is she's in a later stage of life. I'm not saying she's not necessarily old, but she's sort of in that retirement phase or moving into retirement phase if she's not already there. I don't know how old she is, but it just shares with you anybody can actually do this and take control, and she will do very, very well out of her portfolio for doing it. Her stocks, as I said, she had 16 stocks, which is a little bit too many. In my book, I talk about 8 to 12. That's all you need, and the reasons why. You don't want to over diversify. You want to be in the stock. Part of the thing is you want to have enough in the stock so when it does go up, it does affect your portfolio really nicely. But you don't want to have too many stocks in your portfolio so when it goes up, there's not much of an effect. All too often I see portfolios with a few percent in each different stock, because that's, again, squashing that volatility. That's why we have 8 to 12 stocks. So roughly 8 to 12% of your portfolio should be in any one stock, so you get good growth when they do rise, but you're not taking high risk if it starts to fall, especially if you're using stop losses. But look at this stock. This is one of them. This is Alaska Air Group. Now, it's been falling away while the market's been rising. This is one of those ones. So it's been falling away for the last couple of years. So 2 years it's been falling, and it's fallen, what have we got this? Where's my little tool there? Let's have a look at that. It's fallen down around 47.36%. As of last week, it was down 42%. Just a simple rule would have got this lady out of this stock a lot easier and a lot earlier. Just using things in my trading mentor course would have saved her a lot of money. She would have exited just below that low there, which was, I don't know how long she's owned this stock, by the way, too, so I don't really know that. But $89, so selling that around $89 back here, it would have avoided all of that loss. So that's in early April 2017, 2 years ago. So if she'd exited a bit earlier, underneath that low there, she would currently be 34% better off on that one stock. Now, I've got probably 2 or 3 more rules, actually 3-4 more rules that would have had me out of that stock, all up around that price, $80 to $90, a little bit tighter on that. So this is sharing with you why you don't buy and hold, whereas an advisor will. If looking at this stock, if you'd bought this stock back in January 2015, you'd be 4 years not making any money. Now, have a look at that. So if I get my little pointer there from where it is currently right now, we're looking at back there in November 2014. So, really, that's why, as I said, buy and hold is not necessarily the answer, but not bad looking stock. It looks like it's finding some support at this point in time. I'm not suggesting anybody sell it, but look at that. There's some strong resistance or support at $54 at that point in time. So right now, what I'd like to see if this stock to move up, if I do here, and if I put let me see if I can put my little, where is it? No, that's not telling me. Give me a tool. Where's my drawing tools? And there it is. What I'd like to see with this is to do this, come down a little bit, and then start to move up. If we can see that from this stock, then I would suggest it's going to start to move up. If this move downwards when it happens, and it won't be happening for a few weeks, it might go for a couple of weeks. You can see it goes up for a few weeks and then falls away. Goes up for a few weeks. So 1, 2, 3, 4, 5 weeks. 1, 2, 3, 4, 5, 6 weeks. So 4, 5, 6 weeks. If it starts to fall away and it goes quite deep here, then it's likely to go below that. But if it only falls for 1 or 2 and starts to move up, then we might say it's a really nice stock then to get into, and it could be turning into a buy right now. As I said, I would have exited this 2 years ago on my rules and the stuff that I teach. Next one that she had in here, I'm not going to cover all 16. I'm only going to cover a few. Beautiful stock this. Look at this. Illinois Tool Works. Stock ticket code is ITW. I for Indigo, T for Tom, W for Walter. Just beautiful. Beautiful trending stock, and you've got to like stocks like this in a nice portfolio. Have a look at that. You can see this. It's just beautifully moving up and around that. Come back to this and now moving up. So I like this stock. Again, monthly chart, but there's a big fall here. If we go here and we go from that level to that level, you can see again 34.24%. When you get some rules, you don't have losses like that or pullbacks in your portfolio like that. Your maximum return, maximum loss will be somewhere between 9 and 12% using some rules, which means you can come back later and then compound your return. So you're not actually wasting time. So it could be falling away for 6 months, could be falling for 6 years. So you don't lose time value, but you're also compounding returns even after paying for tax, etc. And at this point in time, but it does look all right, this stock at this point in time. So on the weekly chart, looking at this, it's looking beautiful. So I'd say this is now moving up. And again, I would have exited this back, way back up through here, somewhere in around here. February last year, so I would have been out of this for 12 months and putting my money somewhere else where it was growing. But right now this is looking really nice, and I'd be staying with this stock in my portfolio because I think it's got a lot more to go. Let's look at the next one. Is Capital One Finance, and it has a stock ticker code of COF. I believe I can read that properly. Again, nice looking stock, a little bit more volatile since 2009, but you're looking at it's broken through and made a new all-time high back through here, back in January last year. But again, look at this sort of stock for a buy and hold type of thing. You could have bought it over here back in 2000 and you still would have been all the way through here. It comes back to those same prices. This is much more of a trading stock, more so than a buy and hold stock. That said, it's done very well since 2009, back there in that low there at $7.80, and it's now currently at $87. So holding it for that length of time, you've made a hell of a lot of money, but you can make more money if you are more active. So here you've got there 1,200%, currently at 1,000%. So beautiful stock, but there's been plenty of time to get out of that stock and protect your capital. If I use my little tool there again, you can see here how it fell down there 34% between here and in January 2018. So it fell down into December. For 12 months it fell 34%. So right now it's looking a lot nicer. So let's move here so we can see it now. It's looking bullish. So I'd be staying with that stock at this point in time. It does look like it's going to continue to rise back up again and make back some of that money. But you could have exited, come back in again later and have your money somewhere else for 12 months. That's really what I was suggesting here. Okay, then to the next one, we've got Charles Schwab, which is a stockbroker. Now, all too often, if you're using advisors, you'll get consistency depending on the advisor group, but they will generally stick to one broker and or a bank. And so a lot of their clients' portfolios will go into a broker all the same broker's stock and all the same bank, so they have the consistency through their portfolio. So that is quite regular. So Charles Schwab, great. It's a long established company, as you can see. And if I just drag that back out there on the monthly chart, you can see it's been around for a hell of a long time. And again, look at that. You could have bought this stock back in April 1999 at a higher price than what it is currently, but it's done some beautiful moves right through here. But again, another stock that's fallen heavily over the last sort of 12 months-ish. Again, right down in another 30-something% stock fall between that high there in May last year down to the low earlier this year, also late last year. And again, exiting, coming back down. If you're getting smaller losses, that means it allows you to compound your returns a hell of a lot more. And these are the sorts of things you learn from reading my book and obviously doing my courses. At this point in time, it's not showing me it's super bearish at this point in time. So be interesting to see, because we have had that bar down last week in March where it was quite bearish. So far on the weekly, this month so far, it's looking a little bit better. So let's bring up that weekly chart. Interesting thing here will be interesting to see where that continues to go back up again. This doesn't look too bullish to me, this sort of area here. So we had that low back here 2 weeks ago at 41.46. Be interesting to see if it can move back up here and break through this sort of area. Then I'd say it was going up. If it starts to fall away, then this would be a stock that I would look to exit on, or have my stop losses on to trigger an exit. Because if it breaks below that low, then it's highly likely to go down to that low there, and you don't want to go back there and suffer even more losses. So that's 37.83. But if it breaks through that low there at 41.46, just be careful. As I said, again, it's always, to me, number one is protection of capital, always number one. Number two is then looking at what you can buy. And all too often I see people, all they do is look at what they're going to buy rather than how to manage what they've got and how to get out properly. And so that's a real, this one is an interesting stock at this point in time. I'm not super bullish on it. Some of the other ones I'm okay with. Here's another one. I think I've tried to say the name right. I can't even say it's something. I can't. Sorry, I'm not even going to give it a go. Its stock ticker code is PHG. And look at that. It's looking okay, actually, this stock. And we see here it's, again, another one that's fallen quite heavily over a short period of time. Again, another 30% fall between, what's that date there? September last year. Very quick fall. Be interesting to see what happens now. If we start seeing it keep falling away here, if it goes below there, that 39.05, then we might see it start to challenge that and go further down at this point in time. Again, look at that stock. It's not a buy and hold stock. There's anywhere right back through here. You could have bought it here 2000, nearly 20 years ago. This is definitely a stock for traders. If you're trading, and this would be a great stock for traders. You get in, you get out, you get in, you get out, you get in, you get out, because it looks beautiful from a trading point of view. Buy and hold point of view, I would never buy and hold this stock, just based on what I'm seeing. I just wouldn't do it. And there's a few stocks on the Dow I wouldn't buy and hold myself. But let's go and have a quick look at the weekly chart on this so you can see what I'm talking about. Yeah, last week is bearish. You can see it opened on its high, closed on its low, and that's interesting. So it should go down at this point in time. But I'll just put a little tool on here, and that's the wrong tool. It didn't work. And click there, come on. And let's go and put this on here. And put it there. So my guess is it's probably going to fall down to 38 to 37 in that bracket. If it starts to fall, if it falls below 37, then I wouldn't be in it by that stage anyway, probably most likely. But it needs to find some support above that level before I'd make me sort of too excited about it all. But just watch at this point in time. So as I said, it looks like it's going to fall below this low there, which is, as I said, 39.05. But as long as it stays above $38, I think I'd still be okay on it. I'd still be bullish on it. It has moved up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. So it's sort of that 50-50 at this point in time. I'm still hanging on to this stock at this point in time. I don't necessarily think it's bearish, but if it went through that $37, then I would suggest it probably would. But, we've seen this big move up here only for it to fall lower all the way through, lower than that low there, we saw another big move there. So at this point in time, it's be wait and see whether it is more bullish or more bearish. So, but it is an interesting looking stock. It's, as I said, with some rules around it, you protect your profits and you'll keep your capital. That's really what about having a strategy in place for your trading plan, a trading strategy. It's not hard, and this is the thing I'd like to get through to a lot of people. It is not hard to manage a portfolio of really good stocks, and these all look like great stocks to me. And I'm not talking fundamental, I'm just talking about technically. They look like they're great stocks, and I'm only looking at price at the moment, but I'm also looking at pattern analysis. I'm also looking at timing and everything else in my own head. I'm not explaining it to you because I just can't do that on these reports. It's just too much. But I'm looking at multiple different things when I'm talking about them. I'm not talking a little bit about price because that's real easy for everybody to look at. But if you want me to look at some stocks for you, if you want me to answer questions, please just put your comments down below. Also remember to subscribe to the channel. There's that big red button that says subscribe, and there's a little bell on the right hand side of it. Hit the little bell as well, because that will let YouTube, you'll say to YouTube, hey, let me know when Dale's got another video up. And so when you've got YouTube open, it'll tell you to go and look for another video for Dale. It'll come up and say, hey, there's another video from somebody that you like to watch. So please do that. Hit the like button, hit the subscribe button, tell everybody about our channel. That will help us to get out there and help everybody else. But for this week, good luck, good trading. I'll talk to you next time.